On the list of problems, revenge trading. There are a million different forms of it, but people who experience a kind of ego loss, usually more than dollar loss, and then quickly want to recover from that and feel right. And the question I always ask people is, how does it feel to be right? They say, it feels good. I say, how does it feel to get paid? I say, well, it feels pretty good. I say, does it feel better to get paid, or does it feel better to be right if you had to choose one? Obviously, everybody says, well, I'd rather have the money. But the truth is, the actions that people take is such that it seems like they'd actually prefer to be right. They're more concerned with the chart telling them, no, 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 you got it. I believe in you. You're doing great. See, you just had to trade one more time, and then I'll pay you back. Right? They want the ego relief more than they're actually desiring of the money. Because if they're desiring of the money, then it's all just a game of chart pattern recognition with no emotion. Emotion means that there's some ego attachment to it. You know, revenge trading, I often say it's not the first mistake that you make that really screws up your account. It's the revenge mistakes you make because of that first mistake, right? It's not usually the first problem. It's the reaction to that first problem that causes the real downfall. So I've seen this with traders who take let's say they have a $30,000 account, they take a $2,000 loss and panic and want to recover from that. So they trade way too aggressively and they lose $6,000 or $10,000. It's terrifying, but people can financially cripple their accounts in a matter of only a couple days, especially as your position sizing increases. It's like speed in a car, right? The faster you are going, no matter how safe your car is, that increases the intensity of the accident that you might have. Speed is a dangerous and kind of exponentially intensifying. That's not literally how speed works, it's linear. But you know, the impact, the threat of what could occur is exponentially rising as speed increases. In the same way that when your share size increases, it feels like, well, I've traded 500 shares before, I can handle 1,000, but your emotionality is more than doubled. That's what I think I'm trying to express, that your emotional capital is being exponentially risked, even if you are linearly increasing your capital at risk.
Yeah, this is something Zach and I have talked about before that I think unfortunately a lot of traders don't really give enough credence to. Is there's an assumption across the board with a lot of traders that the jump from, okay, I'm paper trading and now I'm live trading. And that is kind of the only real binary that they see, and think that the only real emotional switch that gets flipped is when that transition happens. And then sometimes even when they start slow, they'll eventually have some success and they'll say like, okay, well, naturally now it's time to scale up a little bit and trade a couple more shares. And as they start to increase their share sizes and how much capital they're risking on any given trade, there's an underlying assumption that like, well, this is just an incremental step, so like my psyche is prepared for this. When in reality, sometimes the jump from, you know, even 50 or 100 shares per trade to like 200 or 250 shares per trade, you may not really be able to comprehend what that does to your psyche, and it could be an even more significant gap than when you went from paper trading to live trading. So it should be undertaken with the same amount of conservatism and, you know, just not hesitation or reluctance or anything, but just like the caution to make sure that, you know, if you have a bad day when you've increased your share sizes or something like that, or you're having a bad week, maybe the solution isn't even necessarily, okay, I need to go back down to where I was. The solution could be as drastic as I need to go back to test trading and put myself right back in those early stages when I can convince myself, okay, you still know how to do this, nothing changed. Your mind is just kind of playing some tricks on you. It's making you more impulsive, all of that. Remind yourself that you know how to do the underlying thing that you're trying to do, and then return back to maybe your beginning share sizing for a couple of days, have some success, and then attack right back to the increased share size. just don't convince yourself, well, I'm ready for this. So if I'm not able to make money with this increased share size, I guess I'm not a good enough trader. So I'm either just going to sink or swim at this point instead of admitting, okay, this is harder than I thought. Let me drop back, recover, and then come at it and attack it again a couple of weeks from now when I feel even more prepared.
So people, what you're kind of getting at is they aren't willing to be dynamic in their aggression with which they attack trading. There can be times that you overdo it. There can be times you underdo it. As long as you find a good, reasonable middle ground and can acknowledge the oscillation within that, and it's a controlled oscillation rather than wild swings. Because that's what we tend to see in a lot of failed trades, or traders, I should even say. People who, let's say, here we go, here's a metaphor, car skidding on ice. They try to correct, but they correct too hard. The car skids even harder. They try to correct even harder still. The car spins out, right? A trader who makes a mistake, tries to strongly revenge trade, overcorrect, really might not be seeing how much that additional share size can address their emotionality during the trade, as Jeff was just saying. Over-trading, trading too early, trading too aggressively, chasing entries, yes to all of that. So, we encourage in the VWAP strategy, obviously, we encourage traders not to attack the market during the first 20 or 30 minutes because the VWAP is still kind of establishing itself. We don't know how credible the VWAP is, and we're not going to get any believable pullbacks likely, not always, but likely, to the volume weighted average price. So our best bet at that point is trading during those prime time hours, 10 to 12, and then also 12 to 2, but less of a focus on those hours. That's where I tend to make the bulk of my money. Trading too aggressively or over trading, absolutely. So, I think I had said this in a prior session. Let me actually scroll up, and I'm just going to try and get the exact numbers I had said before. But yeah, if you're practice trading, you should be evaluating 100 charts a day. I mean, you should be getting as much experience as you can, regardless of the outcome of the trades. You should be evaluating setups, right? Maybe 100 a day and maybe taking 20 trades a day. Because again, it's about building experience more than it is about building familiarity, I should even say, more than it is about your quality of experience. It's simply seeing charts and how they react, especially with this type of framework. If you're an intraday trader, I'd reduce that to maybe where you're evaluating 20 to 50 trade setups a day if you can find them. Taking 5, 10 trades a day, it seems reasonable. And if you're a swing trader, obviously slowing that down even further to like a weekly scale to where you're looking at 20 to 50 setups a week and taking 2 to 5 trades a week. And it depends, obviously. You don't have to apply your entire account in those 2 trades, right? You don't want to put half of your account in one trade as a swing trader. Yep. As well said, 10,000 occurrences of trading, not maybe 10,000 hours. Yeah, so like being passive in your chart or screen time, it's not going to cut it compared to I'm going to observe 10,000 potential setups and then how they play out. All right, and not just the outcome, but literally how they play out over the course of the next several candles. So, chasing entries, I think was another thing from that list. Chasing entries specifically, gosh, we got to talk about this. Let me draw in a kind of simplistic chart example we have here. Let's say we have a volume weighted average price. We've got our deviation band up here and a deviation band below. And again, this has nothing to do with the actual price chart. I'm just using this as blank space, if you will. Let's pretend that the market comes down to volume weighted average price after having, let's say, been in the fast lane and struggled to maintain it. So we're now down at the volume weighted average price. We have no evidence at this point in time whether it's going to bounce or violate the VWAP, but what we observe is that it's a flat volume weighted average price. So we are expecting some oscillation. We've had the pullback to VWAP, the kind of magnetic attraction back towards the VWAP itself. But now we're trying to figure out, does it bounce at VWAP or does it crash through volume weighted average price? So the way I'm kind of thinking about this in my mind is If I enter when it's touching the VWAP, that's probably a little too early because I've seen no belief or confidence that other people are here to defend or support this stock. If I trade, let's say, during the first initial bounce off of this support level, then that's a viable trade because I'm entering close enough to where support, and therefore my risk level would be, such that I might be able to participate in a very asymmetric and favorable trade. But what if I wait too long and the trade starts going without me? So the reason we drew this in a bunch of different colors is blue would be too early, white would be just right, and pink would be a little too late. Very straightforward, but what I'm thinking here is if we enter before we've seen any confirmation or any confidence, right, then we're really anticipating a trade setup. We're not waiting for it to present itself. Just as it bounces off the volume weighted average price is where I would feel much more confident taking that trade because we're a balance of early enough in the trade setup, but we have some confirmation. And if we wait too long, notice that the market starts getting a quarter, a half, 3/4 of a deviation away from the volume weighted average price. Ooh, it's pretty far away. And at that point, are you really feeling like you've waited too long, perhaps, for too much confirmation? Because that can certainly happen as well. I mean, I think it's important that the traders really recognize we do not, let me pick another color here. We do not want to trade on the left side of the bounce, right? As it's still coming into the VWAP. And we do not want to trade, I should not have done this in green, I should have picked a less positive color, right? But we do not want to trade after the market has already broken out and started moving based on the support that we defined. There is a perfect middle ground, a kind of tipping point that we're trying to capture because, like I said, that's the best balance of low risk, but still some confirmation. It's a hybrid. So let's add that to this for just a second. We'll call it over trading versus waiting for confirmation. The reason why I structured this trade so closely, actually, let me get my drawing tool back, so closely against that low that occurred at the volume weighted average price is because it was rational to do so having seen reactivity off of that support. We've already seen it start bouncing, so we don't need much more risk. But in the event there's still a bit of wobbling around the volume weighted average price, it's possible we could go out to 1/4 of a deviation so as not to get tagged on one little candle below the VWAP. Once we've already observed support there and it is already launching away from it, it's a lot safer to put your structured risk there. However, in the moment, we might need to give it a little more wiggle room, which accordingly might require fewer shares than we initially wanted to trade. Yeah, having the strength to not trade, very well said. Being willing to sit on your hands until the market presents one of the 4 trade types or in an actionable way, right? So you may have missed earlier in the day a bunch of VWAP setups. It's frustrating to have missed them, but to be willing to not take made up trades that lightly or in some ugly way half fit your definition. Ugh. I see it all the time where a trader will say, well, what about this short? And I'll say, well, why? And they say, and it's no trade type. I mean, I'm just thinking it might go back down to the VWAP. I'm saying, well, why are we even fighting this battle when not at one of the relative tipping points of either the VWAP or the deviation bands themselves? Yeah, let's write that in there as well. The strength to not trade when no opportunity is present. So again, it's kind of like the theory of abundance, right? If we didn't believe that there were more trade setups coming, we would cling on to every possible thing that could look like a VWAP setup because we'd say, well, that's an opportunity. I can't miss out on that. But we know that there are dozens or hundreds every single day. So it doesn't really make a ton of sense to chase after one trade if we miss it, or to feel a fear of missing out. Having the internal strength to not trade when it doesn't make sense, that's something you can only learn by trading a million boring sideways days that you are praying break out. Nothing happens, you lose a little bit of money, you get chopped up, and you say, why did I waste my money? Why did I waste my time? Why did I misdirect my attention? And I think that's a really important question too. All right, there might have been other charts that deserved your attention at that time. This is just a small comment, but I think it's worth making. Markets are not like a cinematic or romanticized journey for you. You're not an action hero. You're not going to have a phenomenal, rags to riches story overnight. You're very unlikely to be the next guy with $1 million account on Twitter bragging about it. Your job is to think more incrementally, day by day, rather than how can I wake up tomorrow and be different? I'm not going to be different. How can I be better is the question to ask. How can I be a better me? Because I'm going to be me tomorrow. I'm just going to be a better me than I was today. When we think about it in that like cinematic, right? Like it's got a movie arc to it. We just think about this like this crucible of adversity that the main character has to go through. But then they prove how smart and strong and rich they're going to be. It rarely works out that way in real life. I always say houses do not get built overnight. They get built brick by brick by brick over a long time. In the same sense, your trading career and your profit and loss is going to be built very slowly over time as your experience improves, as your expertise improves, and therefore you get better over time at getting better, right? You're learning how to get better and how to improve in a more meaningful, substantive way. That is well said. The market has destroyed smart people and made many idiots rich. Yep, no, that's very true. Here, let me write. And so I think what's quite telling about that second little quote there, the market has destroyed smart people and made many idiots rich. This is not a test of your intellect or your quality as a person. This is a test of your flexibility and willingness to participate rather than to control. I think that's why so many people are so bad at it. No disrespect to anyone, and myself absolutely included in that in some ways.
I think sometimes too it actually works inversely, where sometimes the smarter people struggle to actually pick this up. I think sometimes the smarter you are, the more convinced you are that this should be working, so the less likely you are to admit that you're wrong, that you need to change your approach, that you need to dial it back and recalibrate and then reattack. It's more so like, well, I know that I'm smart enough to be doing this correctly, so something is just happening that's outside of my control, so I'm just going to plod forward and hope that eventually the market corrects itself and bows to the whims of which I'm trying to impart on it, because I am smarter than the market, so therefore I should be successful. All I need is a little bit more time doing the exact same thing that I'm doing right now.
Right. When you say, it's almost like an unearned halo effect. You think that if you're good at one thing, you'll be good at other things. You kind of extrapolate that outward. Not only is it a wake-up call, but it's not an apples to apples, no pun intended that we're looking at Apple computer right now. It's not an apples to apples comparison to say that you might have been a skilled professional, a good husband, a good father, and therefore no challenge is too great for me. The irony of this is that the market is a mirror, and it will reflect back upon you your greatest fears and your greatest challenges, because you are your adversary here, right? It's not us versus them, it's you versus you. It's another good point someone made earlier, willingness to discard, let me write this in here, willingness to discard useless or distracting information. So being willing to minimize some other technical elements on your chart, being willing to do away with other chat rooms that are just noise, right? Or calling out excitement. A lot of squawk services that call out market activity, I think, are engaging and fun, but oh, do they really help, or are they really just there to make you feel engaged? I used to watch CNBC years and years ago, and it never once helped me. It just felt like it helped me, but it didn't. Of course it didn't, right? And being willing to do that, being willing to try not operating with that type of information for a little bit, and being always willing to go back to it. So I have a lot of traders who say, well, I can't get rid of that indicator. I can't get rid of my moving averages. I can't get rid of X or Y or Z. Why not try it for a day? If it's really so critical, you will absolutely put it back on your charts. And if you can live without it, then you actually don't need it as much as you think you do. So simplification, streamlining, trying to live a minimal chart life and build on that rather than have way too much, a cluttered chart existence that you have to kind of sort through to figure out what technical elements you're really trying to key in on. Grouping all of your facets of trading into one of three buckets. Things I have mastered, things I am aware of and working on, or things I suck at or don't understand. Right? Three buckets. That's what we'll call it. Very elegantly said. By willing yourself to acknowledge what you have successfully mastered, what you have not yet mastered but are aware of, and things you've never even tried. Have you ever tried coding? Have you ever tried back testing? Have you ever looked into options trading? Have you ever tried this random technical approach? We're not advocating any of those, but we're saying group them so that you understand they are out there and you will get to them when you can. Part of a strategy for mitigating anxiety sometimes is describing what's causing the anxiety. Many times there are traders who will say, well, I don't really know if this is a good setup or approach. I just heard it from someone. Well, how could you get confirmation for yourself that it's a good setup? Could you observe 100 of those trade setups and see if they worked? Could you maybe try to apply some filter to improve the percentage odds of success from those 100 trade setups? I mean, if you can't even describe what it is that you're threatened by, you're never going to get around to attacking it. Sure, talking about fear of pulling the trigger, I would recommend you tell yourself with every trade, this is not a referendum on me. This is an evaluation of the chart. If it doesn't work, it doesn't mean I'm a bad trader. It means the pattern didn't play out. Have you ever looked at the weather? You look outside, you see there's a bunch of clouds, and you say, it's going to rain. And then it doesn't. That happens all the time, right? Especially if you're not a meteorologist. You're just a regular person gauging the weather on the fly. It's okay to observe a likely pattern. Let's say you see storm clouds and you say it's going to rain. If it ends up not raining, that's not your fault. That's a change in circumstances despite the evidence you operated off of. Treating each instance as something you are evaluating rather than you're trying to convince yourself to trade. You should not try to sway yourself to be in a trade or not. Treat it like a detective would. You don't go in thinking someone is guilty. You say, let's find some evidence and see where that points us. Similarly, when you're evaluating, I don't really want to get in this trade. I'm scared. I'm worried it's not going to work. The question is, what does this have going for it? And what does this have going against it? Let me balance the evidence in each hand. And if it's not overwhelmingly in my favor, probably don't need to be in that trade. In one way or another, you are free. You are either free to get in the trade or you're free to let that trade go and not stay obsessed with it. You know, fear of being wrong, to that same point, right? Telling yourself that these are independent, unconnected situations that we are trying to wager a strategic amount on such that we can asymmetrically take risk. We can take a little bit of risk and get a lot of return. To the point of being married to the trade, another one that came in. If there weren't more trade opportunities being presented routinely throughout the day, I would understand being married to a position or to a trade that either hadn't worked or isn't yet working. If you did a lot of work to find a setup, and they were very rare, I can understand the kind of hanging on to that position. But there are 1,000 stocks we can trade every day. There are dozens or hundreds of setups every day. The obvious analogy of there are more fish in the sea, so to speak, is if you go out on a coffee date with someone and it does not go well, if that's the last person you could ever love or be with, well, yes, you probably want to text or call them again and say, let's go get coffee again. Come on, that was my fault. I'm sorry. Let's try again. But if it doesn't click the first time, you probably just aren't going to see the person again because there's so many other viable candidates, so to speak, to try a coffee date with. So the analogy here would be if there's not more stocks for you to trade, I can understand being attached. But there are dozens, hundreds of other stocks for you to trade, probably better looking. And I don't just mean aesthetically, I mean, a better quality setup for a trade. And that's our job as traders, is to constantly be moving our money into the most advantageous position it can be in, given our limited breadth of view of the market and insight as to what's happening. What to do if you're in a trading rut? I would ask, have you been looking at the same tickers over and over? Sometimes looking at tickers you haven't looked at in a long time can actually spark a little interest or challenge your brain in a different way. So if you've been obsessing over Apple, Amazon, Netflix, Google, Tesla, I've always found that a lot of stocks that have a recognizable brand name, but maybe not an exciting stock to trade, can sometimes present really clean patterns that may not be as big as the more exciting high beta moves. Remember though, we're here to try to trade reliably, to build confidence and consistency, and to make a few $100 every day. Set the bar low, cruise over it. Some traders like taking time off the market. Some traders feel like it throws them off their game. So you have to kind of figure out what works for you. I've found that taking a day or two at most feels good. Taking more than that, and I kind of feel like I have to get caught back up to speed with everything that's happened over the last couple of days.